So, who underwrote this AI risk? AI failure is no longer a product issue, it's a capital issue. So, if your AI system makes a bad decision, somebody pays for it, but who? So, whether you priced the risk correctly or not, at the end of the day, somebody's going to pay for it. Most executives still treat AI like an innovation layer, treat it like a sandbox, a pilot, a productivity tool. And that sort of framing is outdated. The moment AI influences capital allocation, pricing, hiring, credit, forecasting, or investor communication, it becomes a leverage decision. And leverage decisions belong to capital. Here's the uncomfortable truth. Most companies deploying AI cannot clearly name the executive who owns the downside risk. If I ask your leadership team who owns AI failure exposure, and the answer takes more than 5 seconds, then you're investing in a speculative program. Let's see, 1 second. So AI leverage decisions belong to capital, as you mentioned, and most people can't tell you who owns the success or the failure of the program. So if you can't answer that question, then you have a governance defect within your corporation, your company, or the companies that you're investing in. So there are operators, there are analysts, there are vendors, and there's dashboards, but there's no single owner of the consequence. So that's not innovation. It's ambiguity financed by capital. Public companies have already seen the market values move on AI influenced decisions that executives couldn't fully explain. Regulators are not debating in or not debating oversight. They're drafting enforcement frameworks. So that's not a theoretical exposure, it's an underwriting exposure. If AI reallocates capital incorrectly, who explains the miss to investors? Who funded the growth thesis? If AI distorts reporting goals, who answers when the guidance shifts? If AI induces bias into pricing or credit, who owns the regulatory compensation? It's the model is not a defensible excuse. Or answer. Models do not hold fiduciary duty. Leadership does. And here's what keeps happening. AI gets deployed in functional silos. Marketing uses it, operations uses it, finance consumes the output, and then based on that, capital decisions are made and influenced. Ownership's not redefined. Decision leverage increases and accountability does not. That is the structural negligence disguised as progress. At a small scale, AI errors look manageable. At scale, AI influences valuation narratives, capital allocation, and investor confidence. Leverage magnifies outcomes. It also magnifies mistakes. When leverage is mispriced, valuation follows. What's actually failing in most AI programs? Not the model, not the vendor, ownership clarity, attribution integrity, board level visibility into escalating paths. If you're allocating capital into companies deploying AI at scale, and you cannot clearly identify the ownership, attribution design, and the downside containment, you're not investing in innovation. You're underwriting ambiguity. Boards do not replace models. Boards replace executives. Investors do not finance ambiguity forever. AI does not remove accountability. It concentrates it. And most leadership teams have not recalculated that equation. Structural AI is diagnosable. Most companies simply are not looking in the right place. That's it for today's LinkedIn Live. We'll see you next week.